Hello and welcome to episode 12 of FTSE Funds and Finance, the straight talking financial podcast brought to you by Goodwin Financial Services. I'm joined once again by independent financial advisors Steve and Josh Goodwin. How are we doing, gentlemen?
Good yourself?
Not bad, thank you. So we're going to talk about what asset classes is going to perform best in 2023. Now, for those that don't know, and let's just kick it off just to make a thing, what is an asset class? And people hear this bandied about all the time. Josh, can you give us a definition of what an asset class is?
If you Google that question, you'll get a range of different answers. But the way to look at it would be a spectrum of investments separated into circles. So you have like cash would be one investment asset. You could have stocks and shares would be another investment class. You have property, commodities. For me, they're the broad range of asset classes you can access and invest into. You could go further than that and start saying different market areas, or you can add crypto into that. But that's generally what an asset class is, like an investment where money can go in an individual area that's sort of separated from others and could basically not have correlation.
And so we're going to talk about obviously what asset class is going to perform best. Steve, why is that important? Why is that important to a client? Why do we need to look at what asset class is going to perform best for 2023?
Well, more often than not, asset classes, and if we talk about stocks and shares, we can split it into individual countries or whatever. But you can talk about growth and value, which are two different investment styles. You could talk about property. You can talk about commercial, residential. You could talk about various different things, but when what we're talking about generally for our clients are investments. So let me give you an example. You have a client that for the last 3 years has been in growth funds. For 2 years, substantially outperformed the market. Done really well. Growth was the place to be.
Yeah.
In 2022, growth was not the place to be, in that the way that the economy worked and it was really, really against the growth market. Rising inflation, rising interest rates, it hurts those companies that are going for growth and leveraging money and whatever they're doing. So the key is, if you look at the table for 2022 and look at asset classes, the mistake that people make is that they will go there and go, what was the top asset class in 2022? I haven't seen the data, but maybe commodities would have been up there. And what would have been the bottom asset class, probably near the bottom, would have been growth stocks. Mm-hmm. Now, what's going to perform best in 2023? You can't actually predict that with any level of certainty. Mm-hmm. This is what we're trying to say here, in that if, for example, the market performs as I predicted on the last podcast, which was from October, the market would hit a bottom and the market would rise. In the environment that I predicted, and that doesn't mean I'm right, growth stocks will outperform. And since October, growth stocks have been a very good area to be invested in. However, if I'm wrong and we're not in that cycle, and we're going to see, there's going to be more. It may be that growth stocks are not the place to be, but the area that performs best will depend on the market conditions. Hence, why you have some clients who will be 100% in growth because they believe in the growth area and they will accept the down performance years. And you have other clients who want to be have a spread of different styles of funds. And what I signify this is, if you've got a shop, I say it's to all clients, if you have a shop and you are selling ice cream and you're going to diversify, you don't sell sun cream. Because if it's raining outside, you're not going to sell anything. But if you're selling umbrellas and ice cream, you're going to sell whatever the weather. Mm-hmm. And it's very similar to the positioning of the funds. Now, once you identify what area you want to be invested in, because to be 100% growth, you've got to accept greater volatility. Yeah. And once you identify, you've then got to find, if you're doing it yourself, people are doing it themselves, that's up to them. But then you find a very good growth fund manager or a very good multi-asset fund manager. That's the key, because you can have growth funds that are really bad at a time when markets rise. So it is an idea of identifying what it is, but then finding the right fund manager. But the most important thing is, and this is where people have this wrong, if they were in growth in 2022, and let's say it was their first year in growth out there, and and they have tanked, it doesn't mean, oh my God, it's tanked, I'm now going to go into value, because if growth goes issue and value doesn't, you'd end up trying to choose which sector's going to perform at the wrong time. So, it's very important to understand that nobody can answer this question without knowing how the market's going to perform. But if you have a chart over 10, 12, 15 years and you chart every single asset class, they will be bobbling about that index. There is no asset class that's going to be at the top. Take bonds. When Liz Truss came in, the month after Truss came in, bonds tanked. That had been bottom of the bottom of the bottom. Yeah. But they have since sustained a recovery. And there will be years when bonds outperform market stocks. So it is cyclical. So the whole point is to say that nobody knows, but nobody should panic. But if you do believe that there is going to be a really good market recovery over those 12 months, like I said, which is, I know we are going back now to October and we're now 4 months into that, then growth has performed well in that first 4 months of that 12-month cycle. And if it does happen up until September like we forecast, then growth will potentially be one of the better performing asset classes. And it's very similar to going back to crypto. Crypto was the best, well, I don't call it an asset class. I don't think we can call it an asset class. It's the Wild West of investing. But when it was performing at top levels, people got invested. But if the last 12 months, it's been an awful asset to hold, probably for slightly longer. So just past performance over that previous year is not necessarily a sign for future, but you've got to therefore understand that if you are worried about volatility of asset class, diversify. Yeah.
So just a couple of things I want to pick up on there and just get your input on that. Obviously talk about growth stock, and we're talking about that. Obviously the opposite of growth is that value. For those that don't know, and I know a lot of people watch this will know, but can you just give me an indication of what you class as a growth stock, or what's defined as a growth? Why is it classed as growth compared to value, so to speak?
So growth stocks would be mainly techie companies that people see that up and coming that aren't quite making profit, but their share price is soaring just based on what people feel is going to happen in the future, not what's happening now. So you'll look at the likes of Tesla, for example. It's only now recently they start to become profitable, but some of their absolutely humongous price gains has been during the time when they weren't making money, but people sort of thought future of the car industry, a tech company, that'd be a growth stock. A value stock would be more of an old school company that consistently makes money, pays out its dividends, and actually it's performing below its price. It's the price earnings ratio. So it's all based on how much money the dividends and the stock is worth, or how much money the company makes. And so that's the other side. So when people talk about growth and value, that's what they mean. Yeah,
because you hear that talked about all the time. I just wanted to clarify. I didn't know if people understood what that meant. And the other thing I wanted to come back to you, Steve, on as well. You talk about diversification there. We hear that all the time. What's the kind of things of diversification that you're doing with your clients in terms of which ways can you diversify? Is it just through funds? Is it internationally? What's the different ways?
Yeah, you look at it on everything. I mean, different clients want different things. So, for example, you would look geographically, but generally most markets nowadays follow a similar type of pattern. You don't normally find that the UK will tank while the American market goes up. But what you will find is there will be different levels of performance, and over recent times, the US market has outperformed the UK market. Yeah. I mean, we've just today, as we're recording this, we've just hit an all-time high on the FTSE 100 index. But, we're going back a decade ago, and the FTSE was not that far behind where it is today, but the Dow Jones is miles ahead of where it is today. But the Dow Jones index has a lot more tech and growth companies, and the FTSE is not that growth orientated, the FTSE 100 is more on the value type stocks. So you can see what basically happens. There's a differential. So the idea is of having an exposure to everything. Now, if you go to somewhere like Japan or China, Japan is still lower. The index is still lower than it was in 1980s. So that's never really recovered. It really bottomed. So that, for example, to go there, you've got to be quite brave. China is another one that is much more volatile than everywhere else. So you get the very sophisticated investors that might want an exposure in that area. But generally, you're talking about working out geographical, where do you want to be positioned, which funds are going to be positioned more to there, which funds have got a bit of value, bit of growth in, the fund manager long-term performance, and and to reduce the volatility for clients. And then within their risks again, because different risks have different funds. So it really is a case of the ice cream umbrella scenario, and trying to say to a client, this is what happens. The issue you get with a client is that when you, for example, and I remember this, we were getting 2 funds in 2021, and the growth fund was rocketing like a machine. The value fund was not. So the client was going, well, I'm not happy with the underperformance of the value fund. Well, the value fund was there as a balancer.
Yeah.
And then, but if you'd had that same fund in 2022, the value fund would have been up there and the growth fund would have been down there.
Yeah.
So, and to be adamant and being saying to a client, okay, this year's value, this year's growth, this year's value, this year's a mix, that's very difficult. And nobody's going to get that right all the time. So the idea being that clients will generally either think, I want to be in growth for the long term, 5 years, and I'm going to sit with growth, or I want to diversify. Yeah. Or a client will say, I want a multi-asset fund because I don't want the volatility of growth and I want a bit of both. Mm-hmm. So that's really what you do, and every single client is individual.
And that's another point as well. It's very complex, and people do it themselves. That's why financial advisors are there. That's why it's important to get the advice that you need, and to get the one you pointed on there, and I want to come back to, is the risk is very important. Making sure you're investing for your risk tolerance. That's the one thing that I don't think is ever talked about on anything you see. Investing within your risk is probably one of the most, and correct me if I'm wrong, gentlemen, one of the most important things you have to get right with your investments to make sure that you can mentally, physically and emotionally cope with the ups 100%. And downs of the markets. And just a point you just said on there, Steve, as well, just to pick up on as well, you said about obviously trust, obviously what happened with her and the asset classes there, and then today we see a FTSE all-time high. That just goes to show what can happen in a short space of time. That's why long-term planning is important. That's why investment for the long term is also important to have. Gentlemen, I think that wraps it up for this time. If you've got any questions you'd like me to put to the guys, if there's any questions about your portfolio, obviously we can't give tailored advice, but if there's any general questions you want the guys to answer, please get in contact and let us know. info@goodwin-financial.co.uk. That's info@goodwin-financial.co.uk, and I can put the questions to the gentlemen. Gentlemen, thank you very much, and we'll catch you next week.